Hi, this is Mark Little. We're continuing our series on Bitcoin for financial advisors. If you listen to many of the most respected Bitcoin analysts, people like Michael Saylor, the CEO of Strategy, one of the most prominent Bitcoin treasury companies in the world, Safedine Ammous, the leading economist in the world, expert on Bitcoin, author of the Bitcoin Standard, when they start talking about the adoption of Bitcoin and what might happen, what's possible for happening, you'll often hear Bitcoin priced in terms that seem unbelievable. We are sitting as of this recording at Bitcoin is currently $110,000 US dollars per Bitcoin. But you hear these analysts and people that are truly respected in the industry talking about, even though it's 100,000 now, it could easily be 300 or 400,000 in the next few years, maybe even this year, 2025. You hear other analysts talk about Bitcoin at $1 million. Michael Saylor, who's one of the most thoughtful analysts that I've listened to, he talks about over the next quarter century, Bitcoin at 3.5 million per Bitcoin. Can you imagine? What could possibly drive that? In this video, I want to walk through a little hypothetical exercise that'll help you understand, again, not what's going to happen, but how that might happen to study what's possible. The reason I'm doing this series for financial advisors is because I keep saying our industry is at an inflection point, and we have a short window of time as financial advisors to figure out how to survive. We've got AI on the one hand, and then we have Bitcoin on the other hand. Both are going to change everything in the financial services industry. That's my assessment. But I believe Bitcoin's going to have a larger impact on most financial advisors than AI. And AI is literally going to change everything. So let's go through this hypothetical and see what you think. We hear a lot about in the adoption of Bitcoin, which is exponential. Bitcoin adoption is growing at an exponential rate that's hard to fathom how fast it's growing. But up until now, Bitcoin, from the beginning, Bitcoin started off as just a little computer token. What is it? We don't even know what it is. That was the first year or two. Then it began to emerge into the money it was designed to be. There was the famous pizza day where pizza was purchased over Bitcoin, and that was in the first 4 years of Bitcoin. So it proved that it could be used as a monetary exchange. But if I'm being realistic about what Bitcoin has been up until now, it's been a store of value. The minute Bitcoin was established as worth something, the price discovery was volatile, but it was steadily growing up. Individuals who chose to put money in Bitcoin pretty much buy and hold. It's the idea that this is a store of value. It escapes local currency, and it's just sitting there maintaining its value. So up till now, it's been a store of value. But what we hear now, after 2024 and 2025, with the advent of the exchange-traded funds with Bitcoin, and also corporate adoption, where you've got corporations on an increasing basis switching to a Bitcoin standard, and rather than holding hundreds of millions, if not billions, in cash and treasuries, they will hold Bitcoin instead. That's many public companies where it used to be just one 5 years ago. It's over 100 of these type of Bitcoin treasury companies today. And then there's sovereign governments. You have El Salvador made Bitcoin its legal tender. El Salvador may be a small developing nation, but the idea of any sovereign government selecting Bitcoin as the legal currency in that country. Even now, the US government has established a Bitcoin strategic reserve. They've signaled the world they plan to buy and hold Bitcoin. In the order, it says Bitcoin may be purchased but never sold. So it's a store of value. But As it now moves into institutions and corporations and government, they talk about this as being the financialization of Bitcoin. What they mean by that is, as the Bitcoin begins moving into other areas of the economy, these governments and corporations and investment vehicles such as ETFs, that's what they're calling financialization. It's a different stage in the Bitcoin adoption cycle. My question is, and the question we're going to explore in this video is, are we dealing with the financialization of Bitcoin, or are we dealing with the Bitcoinization of finance the other way around? Let's dig into it. What you're looking at here, except I'm hiding part of the chart, this is what Bitcoin has looked like for 16 years. It's been going up. I'm showing 109,000 because I snapped this chart a day or two ago. It's currently sitting at 110,000. The point I'm making, and I've made this in several videos, as a financial advisor, your first binary decision about this asset class is it appreciating or depreciating? Now, it looks like it's going up, but let's say 50 years from now, when this chart for this 16-year period is quite small, will it continue going up? Is it structurally designed to appreciate? Or are we looking at something like a heart murmur, like a EKG, where in short periods of time, it looks like it's going up, but when you back up and you look at it over a long period, it's really just going nowhere. It's going sideways. For this, among many other points, I like to point out that when you look at Bitcoin's behavior, it makes higher highs. Every time it makes a new high, it's higher than the last high. That's a good sign. But more to the point on appreciating versus depreciating is to look at the behavior of the lows. After a high, then it goes to a new low. Does that mean the lows are all over the place, or is there support? In this case, there is support with Bitcoin. Every time it makes a new high, it starts going up. When it goes back to the next low, there is support. The market will not allow Bitcoin to go lower than a certain amount. So you have higher highs and higher lows. That is an appreciating asset. So once you decide that it's an appreciating asset, then all of a sudden volatility doesn't look so dangerous. We all know clients are nervous with volatility, but we know, just like when we look at equities, if it's an appreciating asset over time, take equities, for example. We know that in the short term, the stock prices are going to go down as well as up. But in the long term, what we are banking on is through skillful selection of the right companies that are doing very well. If their earnings keep growing over time, in longer periods of time, let's say 10 and 15-year periods of time, the volatility evens out and it becomes an appreciating asset, exactly what we had hoped it would do in a client's portfolio. But in the long term, Bitcoin is much that way. For Bitcoin, I would recommend that you use 5-year average annual returns. If you can get yourself or a client, if you're going to put a small portion, let's say hypothetically, into a client's portfolio, and they start asking you about the volatility, you can explain that thus far, at least, Bitcoin has been delivering consistently 4 to 5 times higher returns. I'm talking about average annual returns than the S&P 500, but at 4 to 5 times the volatility. So to get those returns, which have been averaging somewhere between 55 and 65%, depending on which rolling average you're using and what the current price is. But let's just say hypothetically, the average annual return, when you calculate it, ends up being on a 4 to 5 year average annual return, somewhere between 55 and 65%. Then the question is, what are the short periods of time that are volatile? So how far do you have to zoom back until that volatility smooths out? There is no 4-year average annual return on a rolling basis that I could find. I did the analysis going back in the 4 years right after Bitcoin's inception. I went 4 years out, and then every month I did a new rolling return. There weren't any 4-year average annual returns that had a negative return. So I recommend you use 5 years. It will smooth it out even further. It's something that you can get clients to understand. You never look at Bitcoin day to day. It'll make you nauseous, but volatility does not mean risk. Volatility is price discovery. We have an appreciating asset here. It's going up over time. So how often should we look at it? I would recommend to a client, let's do 5-year average annual returns every time we sit down and look at it together until you've been in it 5 years. Then we'll look at your actual 5-year average annual return. I think the point is it's appreciating. Now, what's making it appreciate? This is really the big question, isn't it? How about this? We think Bitcoin's going up. It's that chart that you saw for 16 years. It looks like a stock. It's just going up and to the right. But what's driving it? It's not earnings. There's no cash flow or cash valuations in the pricing of Bitcoin. Perhaps, and this would be what I would have you think about, perhaps it's money moving out of other things into Bitcoin. So could it be that Bitcoin is driven not by it appreciating, but by other things around it depreciating? And by comparison, it looks like it's going up like a stock. Let's take the US dollar as an example. Is it possible that people are pulling money out of not just the US dollar, but other weaker assets than Bitcoin? This is the chart of the US dollar against 6 other major global currencies. This is the DXY. It's a view of the dollar in terms of its value against other major currencies. Since I got in this business in 1981, more or less my entire career, the dollar has gone down in value against other currencies. Said another way, the other currencies have been considered on a consistently moving basis. The dollar is weaker against these foreign currencies. I think another way to say this also is demand for US dollars and therefore US bonds has been declining consistently since the mid-90s. Could it be that money's moving out of not just the dollar, but all the weaker currencies than the dollar, which is all of them, into Bitcoin? I would say absolutely. That what's really happening, and I show this over and over, on the top half of this chart is what you think is happening with Bitcoin. It looks like it's going up. What's actually happening on the bottom half of this chart is the dollar going down. Bitcoin's just maintaining its value. Bitcoin was designed to have 21 million static supply. That's all the Bitcoin that will ever exist, ever. Currently, there's about 95% of those 21 million Bitcoin currently in circulation. And Bitcoin miners are going to be mining new Bitcoin out of the Bitcoin network till about 2040. We have new Bitcoin coming online, but everything's being priced against 21 million. Because it's the only asset on Earth that has a fixed supply, what's really happening is Bitcoin's just being Bitcoin. It's being stable like it was designed and engineered to do. If you see movement in the price of Bitcoin, it's always against something else. In this case, we're pricing it against the US dollar. Is it conceivable in your mind that what's actually happening is Bitcoin's just being Bitcoin and that the US dollar is declining just as it has with every other major currency in the world? Is it possible that Bitcoin's going up because people are selling dollars and moving it into Bitcoin slowly over the last 16 years? So I'm going to make another point. I'm going to say, let's look at global stores of value up until this recent period before 2024, when institutions began adopting Bitcoin and this financialization started occurring. Look at prior to that. For the previous 15 years, it was pretty much accepted. Bitcoin is just a store of value. This is where you put money, you park it, and you can count on coming back later that your money is still there. If you were to say it the way financial advisors describe inflation or the loss of purchasing power, it's that as these other currencies, by comparison, are losing purchasing power consistently, they keep printing money, they keep making an infinite supply of these pieces of paper they call dollars and other major currencies, they can't resist the temptation to print new dollars so they can go out and spend more money. It's those dollars and yen and euros and every other fiat currency being diluted, debased, and destabilized on a consistent basis. So that what you're really seeing is more or less a steady rise in Bitcoin. But what are other stores of value? People don't just put money in dollars, they put money in gold. They put money in real estate. Have you ever had a client that bought real estate just to park their money? This is a very common tactic with highly affluent clients. I've known affluent clients who have bought 5 or 10 mansions because they needed a place to put the money. They figured real estate, they're not making any more of it. So it's a more static supply than paper money. So they'll put their money in a bunch of mansions. The hope is that value will be there 10, 20, 30 years later. Now, what's the problem with these other stores of value? Gold, real estate, equities, bonds. I think equities is the one, as financial advisors, we are most fluent about. It's a very good store of value in that it's liquid. Publicly traded companies are marked to the market daily. You can get in and out of them if a client needs money. Hopefully, they've been in it long term before they sell it. Presumably, it's gone up in value and you can get the money to the client if we need to liquidate. But what about gold? Gold has some problems as a store of value. Yes, it holds its value. It's held its value for what, 4,000 years? Cleopatra had gold and they valued gold in Egypt. The emperors in Rome coined gold coins and gave it to the military. That's how they funded the Roman Empire and the expansion. So gold has been a store of value forever, but what's the problem with it? First of all, it's heavy and it's hard to move around. The problem we run into with central banks is they try to trade gold between central banks, but it's heavy. It's expensive to move. Yeah, you got to guard it carefully. Back in the Old West, when they had the local wealthy businessman paying payroll in gold, when they'd bring in the gold by stagecoach, they had to surround it with guards. It got to the local bank, which was owned by the wealthy local businessman. When the bad guys came to steal the gold, they didn't go in and steal it. They just burned down the bank because the gold is indestructible. It may be melted, but it'll be there. So gold's been around for a long time, but it's heavy. It's hard to be divisible. The one thing about equities is they're divisible. You can break it down to one share of Apple stock or one share of Microsoft or whatever. Typically, our clients have multiple shares, so you can divide it down to a smaller unit. Gold, not so much. You can melt it and you can make coins out of it. And if they're coined, then that actually adds utility to the value of the gold. But again, it's hard to move. It's expensive to guard. It's a hassle. It is what it is. And it's very expensive. Also, assaying it and making sure that it's genuine gold is expensive. So what about real estate? It's a reasonably good store of value. It doesn't always go up as much as it needs to maintain the value of the dollar against real estate, but depends on where you are. If you're in Miami Beach or New York City or La Jolla, California, yeah, those are high demand real estate properties and they'll hold their value. What's the problem with them? If you need cash, how long is it going to take to raise the cash? It could take anywhere from quarter of a year to a year or two to sell a piece of real estate. And then there's bonds. Let's deal with those in our hypothetical I'm about to show you. I'm combining for this exercise government bonds worldwide, but also corporate bonds, because bonds are a place that individuals have traditionally stored their money in hopes of having it come back worth as much as you invested in it. But as we know, these bonds, if they're US Treasury bonds, and monetary inflation rate my whole lifetime has been 7% on an average annual basis. In other words, they print about 7% more inventory of money, thereby diluting the value of a dollar by 50% over a 10-year period on average. So you have actually the opposite of what clients are hoping. You've got something that you put $1 million in, you buy a 10-year treasury, and you're happy at the other end when you get your $1 million back. It says $1 million when they give it back to you. The problem is it's only worth half the value in terms of its purchasing power. It's been diluted. That's to the point of the half-life being 10 years for $1. Let's look at the hypothetical. Now, what you're looking at here is something that I borrowed this slide from Michael Saylor. This is a Michael Saylor slide. He's the CEO of Strategy. It was the first and most prominent Bitcoin treasury company. But he saw this slide and I thought this would be really great for financial advisors. This is the store of value estimated for the entire globe. It's estimated that there's $900 trillion globally in people putting money into something with hopes that when they come back, they've still got their money. This is so over on the far right at the bottom, you've got what we're calling money. So this is bank deposits. This is money market instruments, short-term treasuries, 90-day treasuries, things like that. What we would think of as money that could be converted to cash instantly. It's about $120 trillion in US dollars, but it's of all global, what we call base money. Every country's got an amount of base money that they keep in circulation because that's how much the economy needs in its wallet to run the country day to day. And then bonds. I was talking a minute ago about combining government and corporate bonds. Globally, $300 trillion in government and corporate bonds. The one I'm hiding is real estate. It's $330 trillion. It's the largest chunk, and it makes sense. A lot of it's investments, but I'm sure at least half is what we would call utility, which is I bought real estate because I need a place to live, and I'm not selling it because it's not an investment. It's my home. Just say roughly right. It's 330 trillion of real estate, and let's just say at least half of it is utility, which means the other half is just sitting there because they were praying to find an asset that would hold its value because they know the US dollar is declining. Then on top, you have the smaller asset classes. You have equities. This is company stock, 115 trillion, 6 trillion in collectibles and vehicles like automobiles, 18 trillion in art, 16 trillion in gold held as a store of value. And then way up there in the top, you've got current Bitcoin. It's about $2 trillion. So what would happen if some of this started shifting around? What if it became clear that Bitcoin is actually not just outperforming any of these assets, but literally destroying some of these other asset classes? Here's what could happen over the next 5, 10, 25 years. Let's just do a little hypothetical. And I want you to think about this. The main thing about Bitcoin that makes it behave the way that it does is unlike money, unlike real estate is the one that comes closest to not creating new real estate. But new areas are developed, populations move to different spots in the country. So places that used to not be so valuable do just pop up and become more. So the land itself is not growing and diluting, but the value of the land underneath is, depending on how it's developed. I used to say land definitely was never diluted, but then I got to thinking in Miami, they are creating new land. When Miami beachfront property became so valuable, they started doing civil engineering projects to create new land. And if you've been to Boston, anybody who's been to Boston knows the Back Bay area of Boston. What is that? That's land they created out of the Back Bay of Boston. It's now a huge area of the city. So I guess you can't even say with real estate that it never expands and dilutes. I guess it does, but it comes the closest to not being an increasing inventory. But gold, yes, they dig out of the ground something like 2% of the gold supply every year is new gold that's added to the inventory because it's coming out of gold mines. What's the effect of 2% inflation of gold inventories? The half-life is 35 years. If you just use the simple rule of 72, take 72 divided by 2%, you've got 35 years is how long it takes for the inventory of gold to double. Therefore, the value of gold to cut in half over 35-year period. Let's just say this, the US dollar is definitely measurable, 7%. Since the pandemic, the monetary inflation rate on the US dollar has been higher, closer to 8.5 to 9%. But I think for the purposes of planning for financial advisors, I tend to use 7% because it's well documented, it's well backed up. There have been studies of M2 and the various money supply measures. It's accepted that the monetary inflation rate has been 7% for the last 100 years. So, what about a new asset that comes online 16 years ago, back in 2009? It's this thing called Bitcoin. It's engineered to be money, like gold, but better than gold because it has a fixed supply and it's divisible. It's easy to move around. You can move $100 or $100 billion across the world in 10 minutes. It was designed to be better money. I know people struggle with this, but it's like any innovation. I don't know why people struggle with money being engineered. In ancient times, they used to catch fish by their hands. And then somebody caught on that if I take a shell and it's sharp and I make it into a hook with a strand of palm leaf and I fish with the hook with a little bait, I could catch a lot more fish faster. Oh, and if I tie those leaves together into a net, I can capture a whole lot more fish all at once. These are all technological improvements. We don't seem to struggle with moving from horses to cars and from cars to airplanes. But for some reason, there's a hang up about the idea of money being engineered and designed to be an improvement over what it has been. But I'm going to go through this hypothetical to just help you understand what could be driving Bitcoin in the future as money moves out of other stores of value into, well, where? It's going to move into something harder and better than whatever it was in. I'm just playing a hypothetical with you saying, what if it moved into Bitcoin? Bitcoin is superior to all these other asset classes. Let's take gold as an example. A minute ago, I showed you that gold has estimated 16 trillion globally. What if we took half of that gold? Let's say Bitcoin continues to perform 55, 65% average annual return. Slowly, these gold bugs who hold gold, they start thinking, I'm going to start slowly buying a little bit of this thing that is not just a little bit outperforming gold. It's like knocking it out of the park. So much higher return. What if half of the gold over the next 20 years, 30 years, moved from gold into Bitcoin? Take half the gold, $8 trillion, do some simple math. Let's say Bitcoin's worth what it's worth today for the next 25 years, just for simple math. We take that 8 trillion and divide it, not the amount of Bitcoin that's currently in supply. Let's price it based on 21 million. We know it'll never be more than that. So you take 8 trillion divided by 21 million of fixed supply of Bitcoin will ever be. That prices Bitcoin at 380,000 per Bitcoin. Now you start to see, oh, okay, these experts, economists, corporate leaders who are experts in Bitcoin, now I'm starting to see how this adoption could gradually occur as Bitcoin continues to prove that it's superior. Don't you think people will start moving out of these other assets and slowly start buying this thing that they previously didn't understand, but it just keeps outperforming the current assets? Let's take equities. I think this is for financial advisors the best example because let's say I showed you a minute ago, there's approximately $115 trillion in public and private companies. This is equity held by individuals and families and other entities, corporations and trusts and foundations and everything. But it's 115 trillion. How many of these companies do you think are going to survive when the public realizes, assuming Bitcoin's performance and adoption continues, how many companies do you think you're going to recommend that have stock performance below 55 to 65% if that's what Bitcoin is delivering? The question is going to be obvious to you and certainly to clients. They're going to be saying, Why would I invest in a portfolio of equities if I just stick it in Bitcoin and it's just holding its value? That means the hurdle rate for equities would over time become Bitcoin. And for a company to survive, they better be providing more value in the world and performing at a greater rate than 55 to 65% if that performance continues. If we didn't take all of the companies, but we just liquidated the ones that couldn't keep up with that growth rate, they were merged or they just went away. Let's say 24 trillion of that 115 trillion moved out of equities into Bitcoin. You take that 24 trillion, you divide that just evenly, simple math, by the 21 million fixed supply of Bitcoin. Now we're talking at Bitcoin over $1 million. How many more years? It's been 16 years. Bitcoin is the number one asset class over the last 16 years. It's been the number one asset class in 11 out of the last 15 years. So how many more years is that going to continue to be a pattern and a trend obvious to everyone? How long until people start moving out of equities into that? Not all at once, but just year by year as they're making decisions what to do with their money. It could just be attrition. New money goes into Bitcoin and it's slowly pulling away from equities. Then finally, I wanted to talk about bonds. I know my head is covering up the word bonds, but a minute ago I showed you there are 300 trillion dollars held government and corporate bonds. Let's just say for grins that 100 trillion moved out of bonds and into Bitcoin. Why? If a bond is yielding 5%, like a 10-year treasury is right now, and the monetary inflation rate is 7%, well, then bonds, at least currently, are underwater. If I look historically at bond yields, they historically are less than the rate of monetary inflation. In other words, they're designed to be underwater. They are not actually growing. They're losing value less than dollars. They're rising 5%, and there's, say, a couple of percent that it's still diluting or debasing. And so it's losing purchasing power. But at that point, it's more like gold. It's 5% yield minus 2% inflation. You've got 2 or 3%. Maybe that's what it's designed to do, is to outperform gold just by 100 or 150 basis points. Whatever the case, if people start moving out of 300 trillion in bonds because they don't like losing money, and I'm talking about the real rate of return on bonds, what if 100 trillion out of the 300 trillion moved out of bonds into Bitcoin? If that's the only asset class that moved into Bitcoin and all the others remain the same, you take that 100 trillion divided by 21 million Bitcoin, you've got Bitcoin priced over $4 million per Bitcoin in US dollars, closer to 5 million per coin. So this is just simple math to make a simple hypothetical point. I just want you to grasp it in your mind how this is happening. I say it again. Is what we're witnessing now moving from store of value of Bitcoin into institutions and other financial assets like ETFs and corporate treasuries and everything, which they are calling the financialization of Bitcoin. But I think what's more likely here that we're witnessing is the Bitcoinization of finance, that it's actually finance bending the knee to the Bitcoin. The Bitcoin's not bending its knee to anyone. So we go back to our chart, we've got all these equities that are not performing as well as Bitcoin. We got Bitcoin currently up at 2 trillion. So what is this adoption going to look like over the next 5 years, 10 years, 20, 25, 30 years as Bitcoin continues, if it continues to outperform all these other asset classes? I think what we're looking at is something more like a white dwarf. In astronomy, a white dwarf is an asteroid that looks like every other asteroid. It's just buzzing around out in space. But when it comes by your planet, it has a gravitational pull and a density so mammoth that when it goes by your planet, it sucks the atmosphere and the topsoil right off the planet. It's just in this case, we've got an orange dwarf. We have Bitcoin. Every time it comes near any of these other assets, it is the apex predator. It proves itself to be outperforming all these other asset classes, if it continues this adoption rate and the growth of Bitcoin, then it's going to just start absorbing all these other asset classes that are not performing anywhere near as well as Bitcoin over time. I know the math was simplistic. I know that things are much more complicated. For one thing, Bitcoin over the next 25 years is not going to hold at a steady 110,000 per Bitcoin. My only purpose in this video was to make a case, the simple case of how assets tend in economics to move towards the stronger, harder, sounder assets. So now you see what's possible. I look forward to talking to you in the next video.